Welcome. Looks like we have a critical mass of people who've registered for this afternoon's program, so we're going to get started. My name is Brian McTiernan. I'm the president of Crumdale Partners, and on behalf of the entire team at Crumdale, it's my pleasure to welcome you to the first installment of our Stop Loss Fundamentals webinar series. I hope that everyone is well and staying safe under the circumstances, and appreciate you taking the time to join us today. We have a great program for you and are thrilled to have over 300 people from brokerage and consulting firms across the country joining us for one of our two sessions today. Today's topic is going to focus on stop loss and underwriting fundamentals. This is the first in a series of webinars we're planning. We're going to dive deeper into stop loss and underwriting topics in the next editions of this series coming up soon. Before we start the program, which will be led by two of the leaders from our underwriting team at Resolute Underwriting Strategies, one of Crumdale's subsidiary businesses, I'm going to turn it over to our chairman and CEO, Matt Naylor, to kick things off and tell you a little bit more about Crumdale Partners. Matt?
Thanks, Brian. Well, first and foremost, I want to thank everybody for being on this webinar today. We at Crumdale Partners and all of our affiliates understand and appreciate greatly how difficult time is for each and every one of us. And I will apologize up front. I'm sure I'm like a lot of you, working from home. And at this point of the day, the house is about to go crazy. I have 5 incredible children. So if I get interrupted here in a second or two, I apologize. I'm the founder and CEO of Crumdale Partners and its affiliates. It's a real pleasure to be here. First, let me just briefly talk about the agenda. I'm going to introduce you to Crumdale Partners. I'm going to talk about Resolute Underwriting Strategies. And then we're going to jump right into the presentation on stop loss fundamentals, stop loss marketing, market trends, and market opportunities. Next slide, Rich. So first, Crumdale Partners. Crumdale Partners is a dynamic insurance enterprise driven by an entrepreneurial spirit and meaningful relationships. And let me just touch on meaningful relationships for a moment. We're very intentional about what we mean here as an organization. First and foremost, it starts with our teammates, and then it moves into our vendor partners, carrier partners, and unique relationships, and then ultimately our broker partners and their policyholders. So relationships are very unique to our business and how we treat them. I founded the company in 2014 with a vision for global insurance solutions rooted in local market relationships. Today, Crumdale and its affiliates is one of the fastest growing purveyors of diversified insurance solutions in the country. Next slide, Rich. Our results are highlighted by our growth rate and our scalability. If you look at the left side of this chart here, our unmatched growth compared to the industry averages. From 2015 to 2020, the industry as a whole has grown by about 4%, while we at Crumdale Partners and our affiliates have grown over 130%. In the middle part of the chart here, we talk about our strong talent acquisition. It probably goes without saying, but you have to recruit and retain, you have to motivate, you have to coach, and you have to build a culture around excellence. And you can see from 2014 to 2020, we've been able to recruit and retain talented acquisition of our teammates. In 2020, we were able to grow that by 50%. If you look at the far right side of the chart, our growing client base is actually very unique to our business and our industry, I think. Since 2017 through 2020, we've on average annually grown our business over 100%. Next slide, Rich. Crumdale Partners leadership team. Our leadership team is very diverse. It's very experienced. We are unified in our vision of independence and innovative solutions. You heard from Brian McTiernan earlier. Brian's our president. Joe Sweeney is our COO, and he's also our president of Resolute Underwriting Strategies. Rob Adams is our CFO, and Jake Wilcox is our executive vice president and CRO. Next slide. So what drives us at Crumdale and our affiliates? One, it's our foundation. I think our methodology is very unique to what we do and how we do it, and the meaningful relationships that we put in a very specific order of importance. Our motivation is to revolutionize the employer-sponsored healthcare plans for self-funded medical plans. And our solutions, they're fast, they're flexible, they're future-focused products for our partners. Next slide. The Crumdale Partners model. We create programs and leverage vendor partnerships to sharpen our broker partners' competitive edge and solve real market problems through industry-leading resources, including local market expertise, sophisticated technology, quality vendors and partners through unique contracting, commitment to integrity, and limitless innovation. Next slide. The challenges we solve. Crumdale Partners cultivates one-of-a-kind ecosystem of healthcare financing and employee benefit solutions to deliver unique value for all of our broker partners. Our solutions are solving healthcare's hardest challenges in today's market. And they're not limited to these three, but limited purchasing power, making affordability and flexibility hard to attain, misaligned incentives among most vendors in typical self-funded plans, and lack of provider accountability for transparency, quality, and pricing. Next slide. So how do we solve these problems? We create change for healthcare's biggest challenges by delivering products and resources for success through a range of solutions. We have a pharmacy practice management consulting business that has very unique contracts around Fortune 50 pricing, contract terms and conditions, and guarantees for mid-market employers. Concierge services. You all know on the telephone, because you are subject matter experts, navigating healthcare is very complex, even for all of us in the industry, let alone employees. So access to trusted aligned resources is critically important. Active plan management around ERISA. Too often people don't pay attention to plan documents, summary plan descriptions, and stop loss policies, and then all the vendors that are integrated into a self-funded medical plan, and hold them accountable from a fiduciary perspective. It's critically important. Our stop loss programs are strategic and integrated reinsurance solutions that fit the unique needs of each and every one of the employer groups that our brokers, our consultants, and agents bring to our firm. Payment integrity. Tackling the fraud, waste, and abuse in healthcare claims is a critical step to have a high-performance healthcare benefit plan around a self-funded medical plan. Value-based care is obviously also critically important. It's not on this slide, but I think it's worth noting. One of the things that we do at Crumdale Partners that I think is extremely unique is we audit and validate every single contract that we put in place, and we also actuarially review and certify the programs that we have. Next slide, please. So it's just a brief overview of Crumdale Partners, who we are and what we do. If you'd like to learn more about Crumdale Partners, please feel free to reach out to one of our associates. Next slide, Rich. Resolute Underwriting Strategies. Resolute Underwriting Strategy offers a unique approach to the medical stop loss underwriting space. We bring extensive subject matter expertise and experience to our select distribution network. And let me just briefly talk about that for a moment. We as a business are not trying to be all things to all people. We're very particular about how we align philosophically with the brokers, agents, and consulting firms that we partner with. And we do it from a limited distribution perspective. We leverage our in-depth knowledge and network arrangements, prescription drug pricing, cost containment solutions, data analytics to drive aggressive pricing and attachment points. We maintain strong partnerships and integrate with our preferred solutions that truly do create unique results. Next slide, please. So today we have two great presenters from our company. One, our Chief Underwriting Officer, Andy Lake, and two, our Senior Underwriting Manager, Rich Harold. Andy's got 25 years of experience. Most recently, he was managing and overseeing a $800 million block of stop loss business for a very, very large national stop loss carrier. Rich also has very extensive experience and history in the stop loss space, both on the reinsurance and commercial side. Rich also has very extensive experience with both large national carriers and small MGUs. These perspectives both are very interesting to the issues that we're dealing with today in the self-funded market space. So with that, I'll turn it over to Andy and Rich, and I hope everybody enjoys the presentation today.
Thanks, Matt. Good afternoon and welcome to everybody. This is Andy Lake. As Matt mentioned, Rich Harold and I will be taking you through the remainder of the presentation. If you do have any questions you'd like to ask, please present them to the panelists on the page you see here. And as time allows at the end, we'll answer as many as we can get to. So with that, I'll begin with the introduction to stop loss. Under a self-funded plan, the employer is responsible to fund all claim expense incurred under the plan. However, most employers don't have the financial capability to handle the very large claim events, either on an individual or a group basis. For that reason, they'll purchase what's called stop loss insurance, which is a layer of coverage that provides reimbursement to self-insured employers for claims exceeding predetermined levels, so that they don't have to assume all the liability for losses arising from unexpected and high medical costs, either on a individual or plan basis. Now, there's two types of stop loss that they can purchase. The first is aggregate stop loss, which provides the ceiling to the amount an employer would pay in claim expense on the entire plan for all members on an aggregate basis during the contract period. The second is specific stop loss, which protects the self-insured employer against large claims incurred by a single individual or individuals during the contract period. And we'll talk about more of these in greater detail now. Rich?
Thank you, Andy. First, I'd like to talk a little bit about stop loss and how it can be looked upon as kind of like a split funded arrangement. You can basically divide the risk into two places, below the attachment level and above the attachment level. And for that matter, you can actually take that to the specific level, specific insurance too, and look at claims below the specific level that's in place or above it. Claims below the attachment or below that specific level are self-funded and fully self-funded by the employer. Anything above the attachment or above that specific level would be covered by the stop loss carrier and is an insured portion of the arrangement. So there's how you can see that. You can consider it from a split funding type of an arrangement. Now, if you look at our little grid on the right side here, you can see it lays out the various components that go into a stop loss contract from both a specific and aggregate basis. You can see here at the bottom in the red, fixed costs. There's something that kind of jumps out at me about that fixed cost piece. First of all, it is the smallest piece of the pie. That represents the insured premium that you're going to pay to your stop loss carrier for specific and or aggregate coverage. And as I said, it is by far the smallest piece of the pie. Moving up the graph, you see the next piece, the claims under the specific deductible, generally 12 months. That's considered a variable cost. The reason why it's variable is you really don't know when your claims are going to come in, when you're going to need to fund them, when you're going to need to be paid. We're going to talk a little bit about incurred versus paid claims a little bit later, but that's the variable nature of it. So the middle box is your expected claims under the specific deductible. On top of that, there will be a corridor put in place. It's generally for traditional stop loss, 25%, although there are different levels that can be purchased. That's the additional liability that a customer or a group would have to fund beyond their expected claims. Putting all of these pieces together, you get the maximum cost that a customer would be liable. You can see here the variable costs are made up of, as I said earlier, the expected claims and then the corridor. That results in what we would refer to as the attachment point. Now, you may hear that called a couple of different things. You may hear it called the ASL. You may hear it called the aggregate stop loss limit. They're interchangeable. They are pretty much the same thing. So now I want to walk through aggregate stop loss at a glance. And Andy kind of touched on this a little bit earlier. It's the form of stop loss that provides a ceiling or a cap to the amount that an employer has to pay in claims expenses across the entire plan on an aggregate basis, thus aggregate stop loss insurance. And it's usually during a set contract period. One thing that I want to emphasize, we're going to emphasize this a few times, is claims reimbursed under the specific stop loss coverage are excluded from aggregate stop loss coverage. And we'll get into a little bit more detail about that later too. The employer has the ability to choose various contract types when it wants to implement a stop loss arrangement. Some may cover run-in claims, some may not cover them, some may cover run-out, but there's a lot of different options that are out there. I will say this, though, typically the contract type between aggregate is going to be the same as specific. It doesn't have to be, but generally speaking, most employer groups go that route. And finally, in consideration of aggregate stop loss coverage, the employer has to pay a monthly premium to the stop loss carrier. Next, I'd like to kind of go through a nice example of exactly how aggregate stop loss works. The box on the left lays out the details of the arrangement that I'm going to go through. You'll see that the very first bullet point is expected claims, and it's equal to $300 PEPM. PEPM is per employee per month. When a stop loss underwriter sits down to look at a particular piece of business, what they're trying to do is they're trying to determine future cost. What do I think the claim liability is going to be in the future? To do that, we may look at case dynamics, case specifics like prior claim history, large claims, network contracting, et cetera, et cetera. So in this instance, the underwriter would have done all that and said, okay, I think going into the next plan year, the expected claims are going to be $300 per employee per month. Talked a little bit about that aggregate corridor. In this example, the corridor is 25% or 125%. From there, we then take those expected claims, put the corridor on top of it, and we come up with the aggregate attachment factor, the aggregate stop loss level, or the ASL factor. Like I said, they are interchangeable. That turns out to be $375 PEPM. This particular example uses 200 employees. Take the 200 employees times 375 times 12, and it gets you to the annual attachment limit, or once again, the annual stop loss limit. That $900,000 represents the maximum liability that the employer has to fund during that policy period. For the sake of this example, actual paid claims during the policy period were $975,000. Because the actual paid claims were higher than the annual attachment point, there is a claim reimbursement made of $75,000. I'd like to point out that normally, in most situations, that reimbursement would be made after the plan year. And once again, just to reiterate, any claims that were reimbursed under the specific stop loss would be deducted from the annual paid claims above. So therefore, that $975,000 includes no claims above the specific. The chart on the right kind of graphically lays it out for you, but it pretty much does the same thing. The employer is liable for $900,000, claims come in at $975,000, risk reimbursed by stop loss is $75,000. Now I'd like to turn it back over to Andy for the next few slides.
Thanks, Rich. As I mentioned earlier, specific stop loss protects an employer from unusually high claim events on individual members. This threshold up to which the employer is responsible is typically called the specific deductible. Let's talk about how that threshold is selected and how it works. The maximum liability or the specific deductible an employer will take can range from as low as $25,000 up to $1 million, and really even higher than that, but generally falls within 4 to 9.9% of expected annual claims for groups under 1,000 lives. Once you get over 1,000 lives, we have a graded scale that we use to determine the appropriate specific deductible for the larger accounts. Typically, and really most importantly, the employer will select an appropriate deductible based upon their level of risk tolerance. Under a specific stop loss policy, employers are eligible to receive coverage for both medical and prescription drugs. In some cases, and this is fairly rare, dental and vision claims can also be included under specific. Like Rich mentioned on the aggregate, the employer can choose different contract types. Some cover run-in, some cover run-out, some cover neither, and Rich will talk about that a little bit more in a bit. And then consider this coverage, again, similar to the aggregate, the employer pays a monthly premium to the stop loss carrier. So let's here take a look at a specific stop loss example. In this particular example, the specific deductible is $100,000. There was one claimant during the contract period that had $175,000 in claims. In this scenario, the stop loss carrier would reimburse $75,000 to the customer. And if you look at the graph on the right, you can see the first $100,000 is risk retained by the employer. And as Rich mentioned, this risk would apply towards the aggregate stop loss coverage. The next $75,000 is risk reimbursed by the stop loss carrier back to the employer. And one thing I'll note is, as I mentioned all this, I mentioned that it's reimbursed back to the employer. Some carriers, including Resolute Underwriting Strategies, have a stop loss feature for specific called specific advance. And what specific advance allows for is the stop loss carrier to pay the claims above the specific deductible prior to those claims hitting the customer's bank account. So in the absence of that feature, the employer would have to fund that full claim and then seek reimbursement from the carrier, which obviously can cause some cash flow issues. So let's go through an example of calculating a recommended stop loss level. In this particular example, there are a total of 500 employees enrolled on the plan. The projected annual claims are $500, or the projected claims, I'm sorry, are $500 PEPM, which again means per employee per month. If you take the 500 employees times the $575 PEPM and multiply it by 12 months, you get a projected annual claim figure of $3,450,000. Earlier, I mentioned that the range for the specific deductible is anywhere between 4% and 9.9% of annual claims. So for this example, that would result in a recommended specific level somewhere between $140,000 and $340,000. Now, again, it's important to note that when selecting the actual specific deductible, what would come into play is the employer's risk tolerance to say where they would like to be within that range and determine how much risk they want to take. Next, we're going to look at a combined specific and aggregate stop loss example. In this example, the stop loss or the specific deductible is the same $100,000. As you can see on the graph, there were 5 high claim events during the policy period. 2 resulted in claims above the specific deductible, one at $175,000, one at $145,000. To the right, you can see on the top, the $115,000 above the specific deductible is risk that's reimbursed to the client. Below that, you can see the $465,000 is risk retained by the employer. And again, this would apply towards the aggregate coverage. And again, just a reminder of what Rich said, the $115,000 on the top that's reimbursed under specific, that does not accumulate towards the aggregate coverage.
We mentioned a few times about contract terms, and there's some terminology that goes with it. A broker and employers have a lot of flexibility to select a time period for claims that they want to be eligible under their stop loss policy. What we're showing here is some typical options that are available. These are not the only options that are available. These are just some of the more predominant ones that we tend to see. 12-12, 12-15, 15-12, 18-12, 24-12. The key issue here that you want to take away is what each number actually refers to. The first number refers to the incurred period. And when we think about the incurred period for a claim or incurred time frame, think about what happens if you go to the doctor today or to the emergency room for some type of problem, procedure, or whatever. Think about when that claim is actually paid. You go into the doctor today, you get your treatment done. That claim by your insurer is not paid today. Now, granted, you may pay your deductible or your copay, but the insured portion of it isn't going to be paid until sometime down the road. So that's why you need to take into account incurred versus paid. The second number in this example is always going to be the paid period. The carrier basically reimburses eligible claims incurred during the incurred period, whichever you so choose, and it has to be paid during the paid period that you choose or chose. So next, I'd like to go through some popular contracts that we see for first-year groups. We like to call it our three little pig example, as you can see here. And if you remember the story, which I'm sure most do, some of the pigs wanted a little bit more coverage than the others. But before I go into that, I do want to point out that, this is generally thinking of someone that was on an insured arrangement and now wants to move into a self-insured arrangement or self-funded arrangement. These are three options that are generally available to you. Before I get into the options, I do want to point out that, we do at Rush and at Crumdale have an actuarial tool that we can use if you have a client that's not quite sure whether or not they want to make that leap from insured to self-funded. So just would recommend if you have something, a client like that, and you need help, please reach out to your Crumdale representative, and they'll be more than willing to help you. But looking at this slide, you can see here we have three different arrangements that a first-year customer could purchase. The first on the left is a 12-12 arrangement, which means it's incurred in 12, paid in 12. So incurred during the current year, paid during the current year. This particular option has the lowest premium, lowest fixed cost. However, because it has the lowest premium and the lowest fixed cost, it also includes the least amount of protection. And the key here is because it's incurred in 12 and paid in 12, it does not include any run-out liability. This type of arrangement is best for employers that are, sensitive to fixed costs and have a pretty high risk tolerance. So let's say you get in there and you say, okay, I'm a little bit worried. I'm not quite sure if 12-12 with no protection beyond that 12-month period is what I want. You can kind of move down the line to the middle box, and you can go out and purchase a 12-12 with a TLO, a terminal liability option, which is what TLO stands for. What that terminal liability does, it offers exactly what the 12-12 does, plus some additional coverage for run out. There is an additional charge for this that would generally be built into your fixed costs. Your spec premium and your ag premium would be slightly higher to purchase this. But what it does for you is it does allow some coverage should you happen to terminate. Let's say you go through the first year as a self-funded customer and you say, you know what, this self-funding isn't what I thought it was. It's not for me. I'm going to go back to insured. Well, if you don't have any type of TLO coverage and you purchased a 12-12 going in, you have no coverage on any of those claims paid after the end of the policy period. And think back to what I just said about incurred claims. When is the claim actually going to be paid? If you're in that 11th or 12th month with claims, big hospital claim, whatever it happens to be, that's not going to be paid probably until sometime after the policy year ends, and that's going to be your liability with no coverage. Now, the most expensive and the type of arrangement that covers the most is a 12-15 arrangement. As I said, it's the most expensive, most robust, and it covers 3 months of claim run out automatically. With the TLO, to backtrack a little, it's usually an option that you can choose or not choose to invoke. With the 12-15, you automatically get that extra 3 months of coverage, but it comes with a cost. That particular last arrangement is best for employers that have a fairly low risk tolerance and are willing to spend a little more to cover that risk. Now, I think there's some takeaways from this particular slide, and I think one of the biggest ones is you got to understand what you're buying and, more importantly, what you're not buying. If you're in a situation where you're showing this to a client, or let's take it a step further and say you have a broker coming in on one of your group or clients, and they're trying to take that from you, and they come in and they present a 12-12 contract to your client. This client today is insured. They show them this beautiful number that looks so good. Now, if it's not explained properly to that group that, hey, yes, this looks really good, but you have to remember it only covers claims incurred in 12 months or paid in those 12 months, there could be a big problem come year two. So like I said, I think the biggest takeaway here is to understand what you're purchasing and what you're not purchasing. And realize that if you're only purchasing a 12/12, that there could be some ramifications down the road. Moving along now, you've gone through your first year, you're coming up on your first renewal. You have to choose, okay, what do I want to use? What do I want for a contract going into years 2+? And there's some things you want to take into consideration when you try to make that decision. You know, what's my risk tolerance? Do I want to buy more insurance? I have a very low risk tolerance. Do I want to buy less? A high risk tolerance. You know, what type of claim lag have I been seeing? Do I have outstanding catastrophic claims? Do I have a high frequency of claims right before the end of the contract year? Think about what a lot of the plans are today. A lot of them are high deductible plans. So right then and there, because it's a high deductible, higher out of pockets, a lot of your claims are back end loaded and don't hit until the end of the year. So if you have something like that, you may need to start thinking about, okay, how do I want to set up that second, third, and fourth year? On the right here, it kind of succinctly points out, think of your catastrophic claims, look at the frequency of your claims, and do I have claims in negotiation? Do I know I have something out there that's going to hit but hasn't hit yet? So you take that all into consideration, and you've now purchased that 12/12. So what this slide here is going to do for us, it's going to layer a year-over-year arrangement of transitioning that first year 12/12 contract, once again, incurred in 12 and paid in the first year. And let's move it to the second year. What do I want to look for? You're going into your second year, you know that any claim that was incurred but not paid in that first year is no longer covered under stop loss. What we're showing here is two different contract arrangements that you could possibly buy that could kind of mitigate some of that non-coverage. The first is a 15/12 contract. The way the 15/12 contract operates is it has the same benefits as the 12/12 for the current year, but not only does it cover the claims incurred and paid in the current year, it also covers claims that were incurred 3 months prior to the current year. Say you're a little more risk averse and you want a little bit more coverage, you can actually move it up to an 18/12 contract. Very similar to the 15/12 with the exception of instead of paying claims that were incurred in the first 3 months prior to the new year, I should say the prior months, 3 months prior to the new year, it covers claims that were incurred 6 months prior to the new year. The key to this, though, is you have to remember that it has to be incurred in those timeframes, but also paid during the current year going forward. Last thing I want to point out here is if you purchase a 15/12 arrangement, if you have a claim that's incurred greater than 3 months before the current plan year, it doesn't matter even if it's paid this current year, it is not covered. And conversely, if you have a claim that was incurred more than 6 months during the current plan year, prior to the current plan year, and paid during the current year, it would not be covered under your stop loss. There is a cost for this. The more you purchase, the higher it's going to be. 15/12 is going to be higher than the 12/12, 18/12 higher than the 15/12. I'll turn it back to Andy.
All right, next we'll talk about quoting stop loss in today's market. So here is some of the information that you'll need to provide to a stop loss carrier in order to get a quote. The first is census data, which includes gender, zip, age, and enrollment selection. And by enrollment selection, I mean, are they employee-only coverage, employee spouse, employee child, or family? Some things we're looking at is, where is the enrollment located? Is there a strong network match where the employees are located? What is the demographic profile of the group, and how will it impact claims? Is it an older group? Is it a younger group? Is it a group more dominated by males or females? That sort of thing. Next, we're looking to get 2 to 5 years of monthly enrollment and claim data. Of course, the more the better. We're looking to see how the group has performed historically. And the more data we have, the better picture we can paint there. We're also looking for any patterns in the claim experience, any monthly variances, and I'll talk about that a little bit on the next slide. And finally, we're looking for 2 to 5 years of high claimant data, including as much detail as you can get us on high claimants. Are they the same claimants year over year? Are there more good years than bad years? And probably the most important question we ask is, are the claims resolved or off the plan? And so we would need as much detail as possible to make that determination. An underwriter's assessment. Oftentimes, when an underwriter is gathering data, I like to equate it to trying to build a story. They're trying to figure out, all right, I've got all these data elements, kind of how does it all fit together and what is it telling me? And things we're looking for is enrollment increasing, decreasing, or remaining steady? What is the demographic and risk profile of the group likely to be on a go-forward basis? What is the variability in the claim experience from year to year, and what are the drivers? And how will those drivers impact the future claim patterns? How will the high claimants perform in the upcoming period? And then finally, and we'll talk about this in a minute, how will the network PBM and cost controls that have been instituted have impact on the claims on a go-forward basis? And it's very important that your underwriter or your stop loss carrier understands what you've done in relation to these things so that they can price them appropriately as they price a group going forward. I often think of all these data points as chapters within a book. And certainly the more chapters we have and the more data we have, we help build a better story. All right. Here are some stop loss factors that are beyond your control. You really can't do anything about this. One is member location. The second is the age sex profile. The third is the industry. And then finally, the past experience. However, there are a lot of things that you can do, and we'll talk about it on the next slide, that do have impact on a go-forward basis, particularly with the claim experience. So these are the factors that are within your control. And again, these are the factors that can have a material impact on the claim experience of your group on a go-forward basis. The first is the PBM contract. Does the contract you have provide considerable value beyond that of the fully insured contract, or even the current self-funded contract? When you think of PBM claims, they can account for anywhere between 20 and 40% of your total claim spend. So to the extent you can have impact on those PBM claims, you can have a very big impact on your overall claims. Data analytics. Are you getting the information from the TPA and the stop loss carrier such that you can sit in front of your client and consult them on cost drivers and ways to mitigate those costs? If you really don't know what's driving your claim experience, it's very hard to do anything about it. Next is the claim review. Claim management, bill review, and other cost controls provided by your claim payer. Is your claim payer doing all they can to make sure that a claim is paid most appropriately before writing the check from your employer? And then finally, advocacy. Are the plan members provided a concierge service to help them find the highest quality doctors, which helps provide for the best outcomes and avoids potential complications, which could then result in additional claim costs? Again, all these are things that are within your control that will have a positive impact on the claims on a go-forward basis. And it's very important as a stop loss underwriter to understand what you've done and to make sure it's priced for it go forward. Stop loss marketing. So I know everybody on this call has, there's dozens and dozens of stop loss carriers out there very willing and ready to do business with you. But what are things that you can look for in a stop loss company? First, that they have experience and expertise to craft the right solution for your client, regardless of the case size, regardless of the current funding mechanism. They contemplate the network PBM and cost controls, we talked about that earlier, and provide a reduced price to reflect these options because they will have positive impact on the claims on a go-forward basis. They include the necessary features such as specific advance. And remember, specific advance is where the carrier will pay a specific claim prior to it hitting your client's bank account, which protects the employer's cash flow. The next is the A rating, which obviously has some impact on your E&O policies. Next is working with the TPA and broker to help find and mitigate risk, and this is really through the data analytics that I had mentioned. And then finally, doesn't have a reputation for denying or reducing claim reimbursements. I'm sure many of you on the call, and I've had experience with this too, where a claim was delayed. Subsequently, it wasn't paid necessarily correctly by the stop loss carrier. I think the key there is to have a TPA and stop loss carrier that give you the data analytics that you need in order to understand what claims are in the pipeline. And so you can work with them closely to make sure those claims are paid appropriately and timely. On the right-hand side are areas where you can procure some of your stop loss quotes. Certainly the direct broker market, you can work with your TPA or ASO markets to get quotes, or you can contact your Crumdale representative who has access to over 20 markets, including Resolute Underwriting Strategies. Next, we'll talk about some market trends that we're seeing. The first and probably the biggest is smaller groups, usually fully insured currently, moving to the self-funded market. You know, they do that for a lot of reasons. One reason I see is that, you know, they feel that their risk profile is better than the fully insured rates they're paying. So they're looking for a solution where they can pay into the healthcare system more appropriately to where they think their risk is. A lot of these smaller groups want to dip their toe in the self-funded water, and they do so through lower stop loss deductibles down to $25,000. This allows them to self-fund, but with lower risk. To capture on this market, we're seeing a lot more carriers, including Resolute Underwriting Strategies, offer level-funded products which appeal to the small group market. Oftentimes, and Rich talked earlier about the aggregate corridors, which are typically at 25% or 125%. What we're seeing for the level-funded products is aggregate corridors down to 100%. And oftentimes, what a carrier will do is package the rates and claim costs together to kind of have a look and feel of fully insured, which is what the employer is used to. We're also seeing very large employers adding stop loss coverage for the very first time at very high deductible levels, $1 million plus. I've seen those deductibles for some first-time groups going as high as $3 million or even $5 million. A lot of these employers are worried about high-cost treatments and drug in the pipeline, and we'll talk about that a little bit later. What they're doing is looking to cap their risk, albeit at a very high deductible level. And for these groups that were bare in the past that are looking to add stop loss coverage now, most of them are adding just specific coverage, not aggregate coverage, because the aggregate coverage is a little more predictable. You kind of know, especially in a large group, what that cost is going to be. But there's a lot more volatility in the stop loss side on specific. And that's where some of the really big claims can emerge. We're also seeing a hardening of the stop loss market, given the increase in high claim incidents, especially around specialty drugs. And again, we'll talk about that in a minute. Carriers are experiencing an uptick of the loss ratio around that. And because of that, what we're seeing with other carriers is kind of a hardening of some of their underwriting rules and requirements. And ultimately, they're pushing through some higher rates. And then finally, we're seeing a lot more emphasis on bending the cost curve through preferred PBM deals or other claim control, disease management, medical management, that sort of thing. The things that we talked about earlier.
Continuing with market trends around high claimants, interestingly, 80% of self-funded customer or employers should expect to see some type of stop loss claim. And generally speaking, that's going to be a specific stop loss claim. Andy kind of touched a little bit about around this with some of the larger employers now implementing very high specific levels that they may not have, stop loss coverage levels that they may not have had before. But here's a claim incidence rise since 2015. Claimants of $1 million to $1.5 million are up almost 25%. You know, 1.5 to 2 million are up over 50%. 2 million to 331. And claimants 3 million plus are up 140%. Now, the base for that is there's not a ton of 3 million plus claimants out there, but that's a big increase. And I've been in this industry for quite some time, and I can remember the days where if you got $1 million claim, it was considered an anomaly. Today, that's no longer an anomaly. That's happening, and it's happening more and more often. Taking into account these larger claims, 47% of these $1 million plus claimants are for claimants under 20 years of age. Congenital anomalies or cancer diagnosis tends to be the reason for them. Another thing driving these higher cost procedures are emerging therapies. This is probably no surprise to those of you on the phone, but specialty medications now represent approximately half of pharmacy spend, and that's anticipated to continue to go up. We're seeing new gene and cell therapies beginning to hit the market with very, very high, extremely high, steep price tags. One of them is Zolgensma, a $2.1 million retail cost. That's for spinal muscular atrophy. During this year, the expectation is 5 new products will be approved, including a treatment for hemophilia. And then over the next, say, 4 or 5 years, the FDA expects to approve between 10 and 20 gene and cell therapies. So that's not only are we seeing them already, but we're going to continue to see them as we move into the future. The last 2 slides are going to focus around COVID-19. Obviously, COVID-19 is very much in the news for all of us. It's certainly, I don't think there's anybody who it hasn't affected in some way. So what we wanted to do is go through a little bit about where we feel the impact is going to be on stop loss. The expectation, at least at this point, and I'll preface this is a study that was put together a few weeks ago, and this is a sort of moving target. We've never gone through this before. Hopefully, we'll never have to go through it again. So it's kind of playing out before our eyes. So this may change, but the expectation right now is that it shouldn't have that great of an impact on traditional stop loss products. That being a specific deductible above $30,000 or an aggregate attachment at 125% of expected. Traditional, as I said earlier, is the 125. Think of it this way: the occasional specific claim for a COVID-19 hospitalization is probably going to be offset, at least to some extent, by the absence of the more routine or elective surgeries. If you think about it, people aren't going in to get their knee replaced now because hospitals are focusing in on the COVID-19 situation. So all those elective procedures have been kind of pushed off into the future. We're not driving as much. I'm going to say that pretty much most of us, if not all of us, are probably doing this webinar from home. I know I am. So there's less less driving, less motor vehicle accidents, less exposure. I mean, my auto insurance company is actually giving me a reduction in cost because we're not driving so much, and I'm sure others are. The other thing is, we talk about traditional stop loss products. That 125% aggregate attachment, it should handle any claim fluctuations within it. Now, as I kind of talked about earlier, if you have a very low spec level, or you don't have a 125 card, or maybe you have something like a 110, you may see more of an effect on that. But generally speaking, it should really be more in those levels. The final slide, also dealing with COVID-19, is what our feeling is for the impact on insured versus self-funded. Right now, we've heard a lot of speculation amongst actuaries and underwriters that going towards the end of this year and into next year, the fully insured renewals are going to see increases as high as 40%. The fully insured carriers are going to try to recoup some or all their losses in the form of maybe artificially higher increases, raising their trend. It's going to be a higher trend off of a higher claim base to determine their rates in the future. I had a pretty long background working for a large national insurer who will go unnamed, and I know how we normally would react in situations like this. And quite honestly, it would be to raise rates. Now, there is one issue that could come into play here, and that's what will the government do? And the government may choose to intervene in some way into the insurance process, which could mitigate some of those increases. But generally speaking, in situations like this, my experience at least has been that you're going to see higher costs. But assuming that the claim increase is actually temporary and it's not really ongoing, and you're not going to see a lot of large claim incidences, COVID-19 should probably have a minimal effect and self-funded from the customer-specific premiums and aggregate claims. The thing that I would point out here is keep in mind, if you're in an insured arrangement and your insured carrier raises your rates, that's your rate probably for the next 12 months. Doesn't matter how your claims come in. If your claims trend downward because there was a blip this year, you're still going to pay that premium. However, if you're in a self-funded arrangement and that same trending down of claims happens, you're going to see it in your bottom line because you're only going to fund the claims that are incurred and paid. So from a self-funded point of view, I think it's going to be a plus. So that said, this might actually be an ideal time to consider moving a group from an insured to self-funded basis. Andy's talked about this before. I mean, for smaller customers, you may want to move to a level funded type arrangement, relatively low spec level, low aggregate corridor that's built to mimic an insured arrangement. There are many types of multi-employer financing arrangements out there that are available to a small, mid-sized group where you can receive the benefits of self-funding and then mitigating that potential risk. Resolute Underwriting Strategies has actually worked with some brokers trying to set up consortiums on the smaller business side around these types of arrangements. So if that's something that might be of interest to you, I'd recommend you, or just learning in general about what might be available to small and mid-sized customers, please contact your Crumdale rep for the availability of these programs. That takes us to the conclusion of the prepared version of the presentation. We kind of hope that you found it helpful and of value. We'd now like to try to take some questions. We ask that you use the chat area and you send them to the panel if you have any questions. We will do our best to answer as many questions as we possibly can, but also be cognizant of your time. We have probably about 5, 6, 7 minutes to do that. So thank you.
This is Andy Lake. Thank you, everyone, as well. We appreciate it. I think we probably have time for a handful or so questions. I'll take the first few. The first is, what do I do if I don't have claim experience for my group? It's a good question. And I'm sure a lot of you have probably encountered this, particularly on your smaller groups and ones that are currently self-funded. Currently fully insured. Most carriers, in the absence of claim data, will ask for what I call individual medical questionnaires on each employee. And the employee would fill that out, giving information on his or her medical condition, as well as the conditions of any dependents that they may enroll. For Resolute Underwriting Strategies, we have a pretty slick online capability for these IMQs, or individual medical questionnaires. And the way it works is if your group does need to go through that sort of a process, we will send to you as the broker a link that can be sent to the employer, an electronic link, and then the employer would forward that on to all the employees. So they would be able to fill that out at their computer or at home confidentially, wherever they would want. They submit all that information, including their signature electronically, so there's no paper forms that would be required, and then they submit that back to us, and we get that securely and again electronically. So there are times when you'll have to go through that process, but at Resolute Underwriting Strategies, we try to make that process as seamless as it can be. Next question. You mentioned savings from claim cost control and other PBM deals. How much in savings do you typically see? Well, a lot of that, the savings that we would see depends on the current arrangement, the current TPA, and what type of cost controls they have, and also who the current PBM is and what they do from a contracting standpoint. What I can give you is some insight of what we see with some of the solutions that we provide via Crumdale partners on both claim control and on the PBM side. In terms of claim control, by adding some of the solutions that we have, we can see a savings in overall claim costs upwards of 5%, again, depending on what they have in place today. On the PBM side, it can even be much more significant. With our PBM deals, we have seen savings on just the RX spend of upwards of 30-35%. So, again, and I mentioned this earlier, when you consider RX spend can be 20 to 40% of the overall claim dollars, saving a third on your RX spend could have a really significant impact on the bottom line. And I know I mentioned it in the presentation, but I'll mention it again. These types of programs are very important for you and your clients, especially if you're trying to bend that cost curve on a go-forward basis. And it's equally as important that not only that you implement that, but when you go to your stop loss market, your stop loss partner recognizes what you've done and is able to price that appropriately as well. The next question I have is there any charge for specific advance? And if you recall during the presentation, specific advance is that feature where the stop loss carrier will pay a specific claim prior to it hitting a client's bank account, thus preserving cash flow. It's an option that is offered at Resolute Underwriting Strategies. We do not charge for that option and standardly include it. In terms of the market, I think it's honestly a bit of a mixed bag. The carriers that do offer it, some will charge for it, some may not. But again, it is standard with us and we would not charge for them. Rich, I'll turn it over to you for some questions.
Yeah, I see a couple of questions or a couple of comments here about COVID-19. One is if total claims aren't going to be affected by COVID, considering elective auto being decreased, why would the fully insured carriers not realize that also? That particular discussion was geared towards the effect on stop loss in general. It doesn't mean that claims aren't going to go up. What it means, though, is that the incidence of specific claims shouldn't increase dramatically. And if you have a corridor of 25% from a stop loss perspective, it should probably be absorbed in there. There was also a comment in there about New York. These are national views. Obviously, you're going to have the hot spots like New York or some of the bigger metropolitan areas that are going to have a bigger effect on stop loss than say the national view. So I just wanted to address those two. I also saw a few around, at least one around talking about, we talk about a maximum aggregate claim liability. Is there any type of minimum liability? Generally speaking, there is. Usually what happens is the stop loss carriers will set up some kind of minimum, whether it's 100% of the first month or 90%. So there is usually a minimum that's built into it. You shared an example of a 15-12 and an 18-12 arrangement. If I had a client that wants to purchase more coverage, is that possible? Yes, there is. There's like I think I mentioned a couple of times, there are lots of different contract arrangements. We just tried to throw at least a couple out there that we see people purchasing as they go from a first year basis into a 2 or 3 year, second or third year. Also, I had one around 12-12 with a TLO in the first year. What happens to that TLO in subsequent years? Does it automatically continue? The answer to that is no, it doesn't automatically continue. It's something that you would have to usually purchase year to year.
Andy and Rich, thank you. This is Brian McTeer again from Crumdale. We hope you all enjoyed today's discussion, recognizing that it's 4:00. We just want to be mindful of everyone's time. For this edition, we obviously spent a lot of time focused on stop loss basics. We're going to dive deeper into advanced topics in stop loss and underwriting in future editions of this series, so stay tuned for more details. Andy and Rich addressed some of the items that Crumdale uses to drive down claims costs, including making sure employers are in market-leading pharmacy contracts. Along those lines, we're scheduled to host a PBM Fundamentals webinar on May 5th. Our team from Transformation RX, Crumdale's pharmacy subsidiary, will provide a great introduction in the fundamentals of pharmacy benefits and the topics brokers need to know to navigate the PBM world. At Crumdale, our focus is on delivering expertise, innovation, and unique opportunities for self-funded medical plans to reduce and control costs and deliver better experiences for employees. We've got a full suite of products, services, and solutions that we deliver to brokers and consultants across the country. Of course, if we can be helpful to you or your clients, please don't hesitate to reach out to your Crumdale representative. Thanks again, everybody, for your time today. Have a great day and be safe.